Hello and welcome to the ByteTree webinar. And it's me, Charlie Morris, who's the founder of ByteTree.com. And today I'm joined by my good old friend, Zak Mir, who's here in London. How are you, Zak?
Very well, Charlie. Good to be on one of your illustrious webinars. I avoid them at all costs, but obviously because it's you, I'm here.
That's very kind of you. I did find last time doing this on my own to a computer with an audience slightly disconcerting. So it's nice to have you very kindly to join me to sort of keep the thing flowing.
I will do that, yes.
Good stuff. So I'm going to share the screen and we'll crack on. And then I'm going to go through a few slides. Zak and I will sort of have a chat about some of them. But then please put your questions in. We've got 3 questions that were already sent in, so I'll address those. And once those are done, anything you sent in, Zak's going to help me answer over the course of the webinar. So sharing screen and share and launch. Now, Zak, can you confirm that that looks good, positioning in an uncertain world? A certain world.
Looks beautiful.
Is it a certain world or an uncertain world? There we go. So very quickly, just looking back at how we've done in the portfolios, this is covering the multi-asset investor, whiskey and soda. And this year so far, as at about a week ago or 2 weeks ago or something, 14th of May actually. Then we've had the soda portfolio up 5.2, slightly behind the diversified balanced index. So FTSE's torn away, and then the whiskey portfolio quite heavily behind this year actually, which happens from time to time. I'm not sure if we're going to get our 2020 result this year, but certainly if precious metals go well, if we get the silver move, then I think we'll fly past the FTSE in no time. But as always, it's the long-term game. We're very, a long way ahead over time with less volatility in both cases. I think it's very important to understand that the soda portfolio is averaged over the 8-year period 5.9 against 6.4 for the benchmark, the FTSE balanced total return, and for the FTSE 100 total return, 2 points of volatility below, giving good risk-adjusted returns known as a Sharpe ratio. Now that's all well and good. You might question whether the whiskey portfolio ought to be half international going forward, as we started to embrace international stocks last year. And I'm glad we did, because you see what's happened to the UK market recently. I don't think the last month or 2 has been great, but bigger picture, it's been a tough place to be. So in picture form, soda had a bit of a wonk in 2023, but generally it's been a better risk-adjusted journey. The number one reason is we didn't own the facts. So if you owned US big tech, which there was quite a lot of exposure in the private balance, because these guys are 1/3 of the S&P, which is 2/3 of all of equities, and so you've actually had a lot of exposure to big tech in a normal 60/40 portfolio. Whiskey had a little bit of Bitcoin, I suppose, which is another version of big tech, and so that was able to counteract that. But a stunning lead over time that we've managed to build up. So as you know, the big picture is driven by the money map. What are the markets telling us in terms of inflation and interest rates? Going back 30 years in the UK data, very similar to US data, really, for most developed markets. And we've had rising bond yields, and we've had rising real rates, but the real rates are only a function of what the inflation is, or the long-term inflation expectations, and those are still being very restrained by markets. And the big mystery, one of the big mysteries, is why the gold price is so high and why the inflation expectations are so low. And this is something I keep on coming back to. Inflation expectations, the red line, broadly unchanged in 30 years, and they bounce between 2% and occasionally touch 4%. But these are not the swings that we kind of see in other parts of the market, or indeed in actual inflation, which of course did have a low print this week, notwithstanding the US still hanging around in the +3% territory. So there's some big questions and uncertainty about bond yields. If you read the newspapers or listened to politicians, you'd think that interest rates are going to be cut. You'd think that bond yields are going to come straight back down. But I just look at the pictures, and it looks to me like the bond yields are going up. Zak, what do you think about gilt yields next 5 years?
Well, I was just going to ask you about why the gold prices have gone up almost exactly at the time, or broke out exactly at the time when inflation is coming down. What sense does that make?
So one of my little theories, of which there are many, as you probably know, is the gold price. If you strip out the duration, so the gold can be modelled as an inflation-linked bond, a story we've been telling for many, many years. That relationship has broken down in the last 2-3 years pretty spectacularly. And I've sort of approached it from another way and sort of said, well, if you take the 20-year bond out of the gold price, what are you left with? You're left with an inflation expectation or some kind of risk feature of monetary debasement. And of course, that line is very smooth. If you take the bond market out of the gold price, you end up with a very clear, smooth relationship that went straight up in the 70s, down in the 80s and the 90s, up in the noughties, down in the teens, and going up again now, very decisively so. So it's telling us to be ready for a second bout of inflation. And inflation is never a steady number. It's always something that goes in steps. It was true in the 70s. It's driven by events. And, we should be on standby, in my opinion, what gold is telling us for another bout of inflation.
I don't believe well, the thing about all economic relationships is that they always break down, like real life ones. And so I don't think there's, the gold as an inflation hedge has just proved itself to be completely wrong. I think to answer your previous question about gilts, I think that the yields there will remain high. It's probably more about that. Yields will remain high because governments are massively in debt, and therefore they need to attract investors into government debt, and that's so it's a slightly different thing, the inflation indication, as opposed to the debt situation, which I think they're probably contrary to what you'd expect, or the existing rules of all that. So I actually think inflation is going to, they're celebrating here. We've had an election because of inflation going down. But I actually think it could go. I mean, it might even go to negative territory. I think it's fallen too fast, too quickly in this country, and I think it's actually this time next year we could be trying to get inflation back into the system. So interest rates are too high here. The 3% of the base rate's 3% above inflation now. I can't remember a time in my 50 years of memory when that's been the case. Normally, interest rates are a little bit below inflation. They're not double inflation. So I think there's there may be celebrations. Inflation's gone down, but I think it's going to go the other way. And they've killed people here on mortgage rates. So that is the reason why we could be in trouble. I think that if you're reading into gilts, you're reading into government debt, which is not the same as inflation, which it should be, obviously.
Let's come to that in a few slides' time. I've got a deficit slide, and then wrong screen. So this is the money map. So at ByteTree, we're great fans of this idea that your investment regime is highly linked to the stability of money or instability of money. And so basically high inflation wants to put you into hard assets, and low inflation wants to put you into financial assets. And on the right-hand side, you've got bond yields going up, risk on, bond yields going down on the left, risk off. Very simple idea. And I've got some examples of things that work in those environments. You can move those. You can be more specific, but very, very, very generally, the S&P 500 likes low inflation, risk on conditions, whereas government bonds like risk off, low inflation. Very simple to understand that. But above the line, you get into our bold product, Bitcoin and gold. But what behaves like Bitcoin? Well, commodities do, and so do banks, ironically. And banks have done extremely well, particularly in Europe this year under the conditions that we've had. And then gold and tips should be best friends, but they've kind of diverged for other reasons. But I do think that I look at the market, I do think we're above the line, and just looking at the way things behave. What are the sort of things going up? Well, it's generally things above the line. The exception being the technology sector, which is just on fire, continues to be on fire. Crazy valuations I can't make any sense of. And it's a problem because people look at you relative to the market. It's a very easy thing to do, but I just think my job, or a job of a money manager, is to understand these long-term things and to recognize that if something is priced unsustainably, then it will unsustain. So, I mean, Zak, where are you on big tech?
I disagree with you. So I think AI is is incredible. Probably the quantum computing thing is right behind that as well. And I think it's right that Nvidia is worth $2.5 trillion, more than the whole of the German stock market. I think that's absolutely spot on. I think we're in a, we are in a in what, it's probably like the .com Mark II, in the sense that, obviously that became the era of the smartphone and mobile communications, and the internet really stretching out. And this is a new railroad. I think AI is a new railroad, and the Americans are obviously good at hyping things up as well. So maybe there's a bit of that there. Maybe the odd $500 billion is overblown, but I think I have to say I think it's spot on. Obviously, that doesn't mean that Nvidia will not be $1.5 trillion valuation this time next year, but I think I can definitely see where they're coming from, and the market is having difficulty in pricing. It's obviously difficult in a nice way if you're long of Nvidia, but it's having difficulty pricing what is a game-changing technology. So thank the Lord for the tech, because obviously without the Magnificent Seven, the US market would not be the colossus that it is at the moment. But probably go a bit, just the relationships and the trends, which we probably are, if you're more traditional than I am. I think that they can be out of kilter for, it's that cliche, going to be out of kilter for longer than you can remain solvent. So I think going with it is at the moment the thing to do, and I think we're probably still at an early stage rather than a late stage in terms of all that. So that's my point.
Thanks, Zach. You just torn up my strategy. So we're in disagreement about that, but that's absolutely fine. It takes two to make a market. I would just come back and say, well, it doesn't have to be a tech stock. It can be McDonald's making really awful burgers, trading at the highest valuation it's ever done in history, and it's hardly growing very quickly. So it's not just tech. There's clearly a big difference between what we're seeing in the UK stock market, for example, and the rest of the world, and what we're seeing over there. But obviously, you're very expert in the UK market, particularly the small cap scene. It's quite interesting. This is a bit of a cheating chart, because there's no dividends, and of course, the dividends on the FTSE will give it quite a substantial lift. But the FTSE 250 is very much the UK stock market, and the FTSE is a sort of remnant of what happens to be listed here. 12 stocks make up 50% of the market in the UK, which we talk about that in America, but it's also true here. And it's all very, natural resources, banks, and pharmaceuticals, basically. And they started to move because commodity prices have moved recently as well. And I do think this is telling us something that's quite interesting. We have finally managed to break out after all this time. But interesting that the 250 has done very well over the years. In fact, until 2014, had done the same as the Nasdaq for about 20 years. And it's only really the divergence that's happened recently, because AI, as you say, is an American thing. And then the next one, we'll just go to global stock markets, going back this century. This time, these are total return using MSCI indices rather than the named ones. And in green, we've got Latin America, one of our positions, which hasn't worked recently. And someone did write in about that, but I couldn't find the question, but I will find it for Tuesday's issue. Why do we continue to hold on to Latin America? Well, on a total return basis, it's a very strong index, and it's it's a commodity cycle, in my opinion. And if that's the case, then that's interesting. And by the way, that green Latin America is very similar to the blue USA total return. In fact, and then you've got the other gang of markets, sort of UK, Europe, Japan, currency adjusted. They're all kind of the same thing, and of course emerging markets. But then, or Asia rather, and then China is the one that really stands out, that's come down. But China is one of those funny old markets, because if you have the Chinese index with the some of the Hong Kong tech stocks and the US listed tech stocks included, it's a very different picture to that red line, which is the Chinese listed China stocks. So maybe the Hang Seng's a better version, but I'm sure one day all the listings will find themselves in the right place, and it will start to make sense. Excuse me, I'm going to drink. So Zach, turn my investment strategy upside down and tell me about the world.
Sorry, about this slide you're talking about?
Any slide you like.
No, I mean, I suppose it is for me after 25 years waiting for the FTSE to break out after many false dawns. It is ironic that at the time of the greatest uncertainty, perhaps here, that's when you've had the breakout. But as you said, the commodity breakout does explain the FTSE move, and also I think you've seen outstanding gains in particular stocks. Where there's almost been a sort of a flight to a few stocks, which is the sort of fund manager herd mentality, and I like that as well. I think it sort of shows that there is selective interest in the UK, and there is the money there to back those particular moves. But I am UK focused, and well, UK and US focused, so the rest of it, I'm not a great fan of China. So the rest of it rather passes me by. Almost bare of China just on principle, which is probably a bit controversial, but that's the way I look at it.
Good, thank you for that. But I think what's really interesting is the clustering here. It's just the way that those bottom markets and it's all down to big tech, which of course we disagree on, but that's fine. My favorite subject, which ironically, we all know that the correlation of big tech and Bitcoin are very similar. Bitcoin outperforms big tech, and I just made my bed there. To me, it makes complete sense that the digital alternative asset's doing really well, and it doesn't have a PE ratio. And I take comfort in that. And I think if you look at these big tech stocks, Apple being the biggest, most valuable one, with zero growth for quite some time now on a 30x multiple. It makes no sense on any investment grounds. Nvidia, of course, is growing very quickly, but that's basically the fact that the only guy in town with this valuable product, and it just takes a competitor. Once we have a competitor, then those gross margins will come down, the share price will come down very quickly. But of course, one of the reasons why Apple's so high is because the system has been very successful in banning the likes of Huawei. And so, we haven't got many alternatives in terms of cheap mobile phones. So we pay more for that. And these tariffs, what it's doing is basically keeping out cheap, good products from our market. And so people need to think about whether that's good or bad. I think it's bad, personally.
Say that Apple should be regarded as a utility stock, or is it a data stock? Well, what's your definition of what Apple?
I don't really care. It's very big. It's at the end of the game. It's got a huge valuation, and I doubt its margins are sustainable. And all of these guys, I remember 1999. One of the arguments was, this game is tired when all the different entities are competing against each other. What they meant at the time was, private equity was competing with hedge funds. Hedge funds were starting to say, we can't find new trades anymore, so we'll start to do private equity. And private equity would say, we can't find anything to do, so we're going to do this hedge fund thing. And so they're all competing with each other. And what you've basically got now in the big tech stocks is them all clambering over each other to buy these AI chips to make something that we don't know is profitable yet. I've tried to use AI many, many times, and with advice from people, tell me how it's useful, and it's just awful for what I try and do.
I think it is. It's a bit like the lasers were in the 60s. It's the technology looking for a function, and but yeah, you're right that mostly it's AI doesn't seem to be any better than the existing chatbots that we're familiar with even 5 or more years ago. So that's no use. The other thing, I suppose, is that AI is useful in certain. For instance, like editing a video or this or that. There's sorts of things like that, but there's nothing really which is at the moment game changing. It is a bit like a laser. You could use. It had initially very marginal uses. And I think it's still AI is still something which is looking for a proper home, apart from just surveillance and spying on the public, which is probably what it's going to be doing, and working out whether people are paying tax and this sort of stuff. So I think it is quite early in that, and maybe that's why I'm bullish about it, because it seems to be early days.
Yeah, no doubt. But I've just been writing a piece on Atomic today. It's our Bitcoin piece that we put out monthly, And I've been looking at Bitcoin's energy consumption. And it turns out that it uses about 0.2% of the world's electricity, or about 500,000 homes, which is basically Northern Ireland, a bit less than Northern Ireland. And by the way, that's according to the data that I sourced or cited rather. That's slightly less than gold mining. So it's quite an interesting battle of where this is all going. But basically, and it's something I didn't touch in the article, but I will come back to another day because actually quite a lot to research. But basically, AI is going to consume way more electricity than gold and Bitcoin combined, way more. And I think that we've got to, as a society, really think about that, because the green policies of recent years have been about the European interpretation of these green policies are basically could be summarized as please consume less energy. And at the same time, you have the same politician asking why UK productivity growth is failing to grow. And you can't have it both ways. You can't have, productivity growth is basically energy consumption. And so if you want lots of AI, you need lots of electricity. And but we'll move on. So Bitcoin and gold, and obviously fantastic move in gold the last few weeks as well, where we've seen the time high challenged again. And my thoughts on bold, a very, very nice way to blend these two ideas. Now I come back to the debt and deficits, which is really, really important. It's the structural reason, I think, of why we should be worried about monetary inflation, because these are really, really big numbers. We have peacetime high debt GDP ratios, which everyone knows about. No one in this election that we'll come on to in a minute is going to talk about balancing the books. No one in American politics is talking about balancing books. I was told that 30, 40 years ago that it was a normal thing in elections to demonstrate economic competence and and make a big point of it, of how we wanted to spend the nation's money well. But now it's just a blank check. And so I don't see how these deficits can turn into, a small deficit's okay if you've got inflation, but I don't see how they could ever go back to surplus. So I don't even see how we go back to small deficits. So I think this is the sort of flow of money that's coming into the system when the money supply is no longer growing, driving the likes of gold, Bitcoin, and probably your big tech stocks.
Yeah, no, it's a nightmare of big state, high tax, and various welfare gravy trains, and we can't wean ourselves off that. I think the moral hazard, there have been a couple of moral hazards. The first one was the QE situation, where this country lost £85 billion, and nobody seems to be bothered about that, or the Bank of England did. And then the second one was paying everyone not to work, or paying people not to work in the pandemic. And I don't think we've really, I don't think we've really backed off from that. And that is a problem. You also have the problem that if you tax people a lot, there's not actually much reason to work, unless you're very keen, which obviously you are, Charlie.
Well, I am quite keen.
But I think that the debt thing is it's the elephant in the room, in every sense of that cliche.
Okay, moving on to commodities. The input cost to life is commodity. If we want to consume stuff, go somewhere, or have stuff, then we need things like copper and oil and many others. And food, of course, is a function of other commodities, because it's basically diesel, as I've argued for a long period of time. And this has been quite important in the portfolios recently. I think that you could argue that oil is more the normal economy, whereas the copper is more the investment side of the economy. So it's oil being sort of consumption and copper being investment. I think I wrote last week, Jeff Curry, the ex Goldman Sachs commodities analyst, who's now at Carlisle, he thinks that copper is going to go crazy, and he thinks it's a really good trade for the next 2 years with 50% upside. I pointed it out on a chart which I haven't reproduced because I only put it in a piece earlier this week, that the copper and silver just look extraordinarily similar on so many angles, and I think the silver will just follow. So could you need to buy copper? Probably not. But we do have, of course, the BlackRock World Mining Fund and various other similar things, but these copper stocks have moved quite a lot. But I think it's just having an association with that top right box of the money map, which would be these sorts of stocks and heavy industry in general, is where I just feel very comfortable, where the valuations are right and you can just feel them being underappreciated. And of course, the big tech switch in 2000 and 2001 It just saw old economy. Old economy didn't surge. It just was unaffected by the collapse in tech. But then also you've got two types of tech. You've got 2001 tech, which is the speculative no profit tech, which is basically the 1999 tech. And then you've got the new quality tech, which is the sort of Microsoft type trade, slow growth, but it's the sort of stock that's replaced Unilever and Nestle in its portfolio usefulness. Yeah, and that's kind of how I see it. Now, we're looking for a joke now, Zach. I need your funny joke, please.
We've got two jokes, right?
Sorry?
We've got two jokes there. So
that's even better. Okay, that's the election, and this one's not the election. There is no election. There's never an election. That's my joke.
Well, I think it is interesting that we in this country or in the West, you're choosing between two. In this country, anyway, you're choosing between PepsiCo and Coca-Cola. They're two very similar forms of government, which means effectively you have an elected dictatorship, and obviously in the other areas they decided to just forget the electoral side and just have a dictatorship. But I think that my bugbear is that since the Cold War ended, actually, we met the Soviet Union and China in the middle. They didn't become free, but we've adopted. They took our capitalism, but we took their big state and big control thing. So not sure what the point of voting here is either, actually, at the moment, unfortunately.
Well, perhaps the questions will touch on the election, but let's get through the business first. So I've got 3 questions that were sent in. So Zach, if you'd be kind enough to
I can't magnify the screen on that one, so you might actually unfortunately have to read. I can read the chat questions, but I can't read the.
Fine. You get ready on the Q&A, and I'll crack on with these 3 questions. So I'll read it out first. Given that your selling decisions seem to be quite a difficult area for many in the private investment community, I wonder if you could share your thoughts and process around deciding when to sell in the whiskey and soda portfolios. Absolutely correct. It's really hard to sell. Much easier to buy things you like, and then have to change your mind for various reasons. But there are many different reasons why we would sell. I know you've already addressed the capital gearing trust and the rougher investment trust in detail, but I'm really interested to understand why you hold some stocks such as Rank, well, it's deep value, and also Rank, that was a post-October 2022 trade. So at that time, I turned bullish, and probably should have done much more to make the portfolios longer than I did. But nonetheless, I put a bunch of stocks in, including Marks & Spencer's, which you come to, and Rank. Rank popped on the recommendation more than any other stock I've ever recommended ever. And so the book price in the portfolio is much higher than the recommendation price. And so I think there have been a liquidity air pocket that day. But I think that Rank is a cheap stock. And I'm very happy to hold it because I'm waiting for someone to buy it, because basically it's one of those waiting for a bid type UK situations. We also mentioned Drax and Centrica. Centrica was a great call. That was very much against the grain. It was a very unpopular stock. We bought it. We made good money. I sold it because I just saw the natural gas price up in the North Sea coming down about 18 months ago, a year ago, and I started to worry that at some point that would impact Centrica or see a stall in the further progress. That kind of turned out. It's probably about the same price today as what we sold it at. Drax was something that I changed my view on. I thought the numbers are amazing on Drax. It's a screaming buy on numerical grounds. But then I realized there was just one policy decision away from being worth pretty much nothing. And so it is a very controversial stock in the FTSE because most of its value is all around government policy, which could change at any time. And then you've got the question of which government. I don't know if the new lot like burning wood pellets or not, but Drax is down quite heavily today. It's one of the ones that definitely had a election uncertainty along with the whole of the utility. So yeah, so why would you sell things? So Marks & Spencer's was probably the most interesting one because that was a great pick, and obviously it went on to do great things. And as we all know, it's all over the papers now that Marks is a great recovery story. And it was a basket case when I recommended it at a very low valuation. But I sold 6 stocks, I think it was, on the same day in February or March, February 23. And that was when the banks all started going down. So we had the Silicon Valley Bank firstly, and then we had the Silvergate Bank, and then we had Credit Suisse. And it was, I guess it turned out to be nothing, all these huge bank failures. But I think it was the right thing to do, and I'll do it again. So if we suddenly start to see lots of large organizations fail, then it's a good thing to lighten up your portfolio, which is exactly what I did. With Marks, then I probably wish I should have bought it back. But most of the other things I saw at that time actually went on to be lower and haven't really done much. So actually, on balance, it wasn't a bad thing to do. But yes, I wish I'd kept Marks, absolutely. Two more questions. Sorry.
Just on Marks. Wasn't it the case that when you recommended it, it was difficult to work out why it was so hated, and now where it is now, it's actually quite difficult to work out why it's done so well.
Yeah, but I'd say the redesign of some of their food halls is great. And I've got a young child, and you can sort of press the button in, and Peppa Pig spins around and dances and stuff like that. Not Peppa Pig, the other one, Percy Pig. And it's good. They thought about it, and it's good. And yeah, John Lewis is in trouble, so they must be doing something right.
All right.
Question 2, with government household debt rising to extreme levels in the US and inflation refusing to drop, it seems that the US stock market is bound to crash at some stage in the coming year or so. Well, it's bound to crash at some stage. I just don't know if it's in the coming year or so. If history repeats, then that will affect all stock markets, absolutely, and the world economy, absolutely. It seems to me that there's a rare investing opportunity coming, as well as a potentially very scary scenario. How do you determine the balance between holding on to all the exceptionally good value stocks that are in whiskey, soda, and venture versus moving into cash, reduce losses, and to be ready to take advantage of beaten down stocks? It's a difficult one, but it's a fine balancing act. I think you wouldn't just liquidate a portfolio overnight. You would sell a couple of things and then give it a day or two. And if things are still deteriorating, sell a couple more things. So you're just moving into the direction of the trend, I would think, is the best thing I could say. So identifying what the problem is. And the moment we haven't got a problem, we've got plenty of setups. For example, we've got a big deficit and a huge debt to GDP, and we can't see a solution to it. But nothing's going wrong. The stock market's pretty happy. The 200-day moving average is upward sloping. I don't think there are many weak areas of the stock market generally, apart from UK utilities today following the election announcement. Most things are pretty happy, or at least stable, and there's very little volatility in the system. But as these things start to change and deteriorate, that is a reason to lighten up on risk generally. And you basically, in the words of Anne Robinson, you sell the weakest link. And I think that's what I've been doing for a very long time now. And a lot of the portfolio outperformance over the time has come from having good bear markets. And you still lose money, but just not nearly as much as the people who have bad bear markets. If you own highly speculative stocks and very high valuations, you can have shockingly awful bear markets. And in 2021, a lot of people would have seen 90% losers in their portfolio who are hanging around green energy themes or high growth, tech stocks and that sort of thing. We didn't have that problem, which I'm proud of. What other stocks in the portfolio at higher risk if the US market crashed? Well, that's probably why my emphasis on value investing today is so strong. Now, I tend to think of myself as sort of quite flexible, quite happy to do a bit of this and a bit of that. And have an efficiently diversified portfolio. And actually, if I was really happy with the backdrop, I wouldn't mind, having a bigger emphasis on certain areas of growth without being so mindful of worrying so much about the valuations. For example, do you remember a couple of years ago, or 3-4 years ago, we used to come in and out of the iShares World Momentum strategy from time to time. That sort of thing, which gets you into these tech stocks. So if you think the world is stable, it's a perfectly reasonable thing to do to capture the idea of a strategy like that. But I'm very uncomfortable with it for many reasons. Mainly, it all comes back to this concentration risk, which is strange. So to answer your question properly, what's at risk? Well, if I've done my job correctly, then I think the overall result of the portfolio would do well relative to the market. I mean, let's take the whiskey portfolio. It's a third Bitcoin and precious metals. Bitcoin's going to crash in a stock market crash. I mean, let's not face it. And precious metals, will they go up? No, but they won't go down as much as the stock market. The gold mining shares would probably take a knock. You'd hope the yen would go straight up, unless that theory is completely wrong. But you would hope that reversal of trends would see the yen go straight up whilst everything goes straight down. But again, these things are all unknown. You'd also hope that in a US stock market crash, that would also be good for the bond market. Should be. If we've got a real problem, if it's not, then the world really does have a problem. If the bond bear market causes the stock market crash, that's not good at all. That's what happens in emerging markets. So I'm absolutely thinking about this all the time. You're trying to make sure that our portfolios are making money, but in the most responsible way possible. And I'm as a quid pro quo, one has to give up the idea of relative performance being really important at the moment, because you think that the risk management is more important. You know, if I thought the risk was much lower, the big macro risk was lower, I would worry less about that sort of thing. Maybe I'm over worrying too much, but I do think that our portfolios are pretty well constructed, given the good and bad news that we face. Question 3, BHP Anglo American, very much in the news. And there's a customer major uplift in mining M&A. Well, I hope there's not too much more, because if you look at these indices for oil and mining, they're coming down to 1 or 2 stocks, a bit like stock markets in general. There used to be so many names, and now there really aren't. And in particular, do you think that we are likely to see the majors attracted to the junior miners and explorers again, the likes of which we haven't seen for more than 10 years? I'm particularly referring to the green metals and gold. Well, we've started to see a little bit of evidence of the junior miners going up. We've seen some pretty aggressive consolidation right across the board, as I just mentioned. And yeah, I mean, how much more is there to do? I mean, Zach, what do you think about big oil and big mining and the choice we have as investors these days? I mean, going back to what Jeff Curry was saying, he said, you know, back in 2000, forecasting this big surge in Chinese demand for commodities back then, it was much easier for the big companies to merge than it was for them to go and, you know, drill more holes. So that's why they do it. So it is a sign of higher prices ahead.
I think it's amazing that the major miners, have been able to basically last out since what, 2010, 2012. Without having to basically explore or take over other smaller companies. I think that is amazing, because obviously we were told there'd be supply deficits, probably 10 years ago, 12 years ago. I think it was the big Glencore moment. When was it, 2012 or something like that? But it finally looks as though the big miners have run out of their reserves, and they need to either merge with others or buy juniors. And that is it is interesting how long it's taken, but I suppose it's maybe also related to the breakout in the, everything fits together, the breakout in copper prices, gold prices as well. So it's all sort of happened at once, and it's needed to happen at once as well. So the commodities have driven M&A, and M&A maybe is driving the commodities.
Yeah. I can't disagree with that. Right, we've lost the presentation now, and we're going to hand over to you, Zach. You are the question master, and let's go. And if you want to join in the answer a little bit, if it's a ByteTree direct question, leave it to me. If it's a more general chat, feel free to interject.
Okay, so question number 1: you recommended selling 100% Ethereum held in ByteFolio. Could you elaborate on this? Are you likely to buy that?
So this is not a whiskey and soda question, so I'll do a very short answer, but I can certainly write about it next week. It was basically driven by the fact that Ethereum is a massive underperformer. I think the value of the Ethereum network is 1/20th of Bitcoin. Is that right? No. Sorry, I beg your pardon. One fifth of that's BNB of Bitcoin, and that gap just seems to be widening. And our network data was showing that the Ethereum network was no longer growing, and there are competitors. We own Solana, the junior competitor, but this is nonsense to most people because they know what we're talking about. So let's get back to equities and bonds. Let's keep Bitcoin in and everything else out. Crypto.
Right. Last week's Merrin podcast guest made a good case for Dowlais. I think it's pronounced like Dowlais. Dowlais. Post-divestment sellers are now gone. Is it worth increasing the holding in whiskey?
Really good question. And so this comes back to the spin-off. We owned, the old GKN was swallowed up by Melrose. who you probably know quite well, Zach, and we ran Melrose after the spin-off, and I reminded people, our readers, about the great opportunity that can come from spin-offs, where the weaker half, the rump as they call it, often ends up being the better investment in the long run. And so I just never sold the Dowlais. It was a tiny 1% of the portfolio sort of position. It's really cheap, and it got cheaper and cheaper and cheaper. It's now so cheap, and so one thinks, should we actually increase the position in this one? I mean, it's certainly something I've been considering, and I have kept an eye on it. But I was just waiting for a bit of technical strength before I started, digging in. But so far, it's been a bit of a shocker. But that's fine, because we just add to it at some point, and it will be forgiven quite quickly. So that was really the plan, for a small position to be added to, and they're basically in the auto business, and it's the less glamorous side. Melrose, got the tailwind of defence and the helicopter division and that sort of thing. So that's why it did so well. And actually, I thought we'd got the top, but it's had another run again, as all the defence stocks had. But that's on a high valuation. Dowlais on a very, very low valuation. By the way, it's down on third this year. So, yeah, we should probably look at it.
All right. In Soda, we have a big holding in the Japan ETF. To date, it's fallen 18%. Is there a point that you would consider exiting?
So this is not Japan. This is the yen. This is our portfolio hedge. And it hasn't been a good investment, that's for sure. But it's been a hedge, and it's undervalued. I've written about it more than anything apart from Ruffer and CGT, I think. So I don't think I've got anything fresh to add for what I said. But every time you look at the portfolio and see the portfolio's done well, the yen's down. That's been the story of the last year. And so therefore, it stands to reason that the reverse will be true. This is what happened in 2008. In the run-up, the yen was this sort of funding currency, and then everything went pear-shaped. And when it did, the yen rallied massively, and it was a very liquid trade. And it's all these short sellers who have to come suddenly when things go wrong. And that's why I hold it. I just sort of feel this cycle. There's so many uncertainties in the background. What else would it be? And it's been right to assume that the hedge is not bonds. It might be that it could be bonds going forward. But I just find it a struggle, because there's just so many of them. There's just no scarcity about it. And the Japanese money supply has been reasonably tight. There is a misunderstanding with their huge debt, because it's basically two sides of the government. One side of the government owns the other side of the government, loads of money. And it's a funny old country, because it was the first one that went through this whole huge bubble and collapse back in 1990. So it's been a hell of a long time it's been in this situation. And what would be the portfolio hedge if it wasn't the yen right now? Maybe you shouldn't have one at all. But I think that most of the damage done to this trade was over a year ago. It's been a very slow faller recently. And let's not forget, the other thing that's happened recently is the pound's shot up. So it's not so much the yen, it's the pound goes up. So when you have a currency trade, unlevered, thankfully, then it's two sides of the matter. And the pound has been pretty much the strongest currency in the world the last year, or the second. So, take that. So even if the yen had done nothing, that trade would have gone down slightly. But I do think that it's going to be there'll be a time that we'll be really happy that we own it. But of course, this is a newsletter. You don't have to own it if you don't like it. But I like it, and I understand why we own it, and I think we should own it, because otherwise I've got no counterbalance in the portfolio whatever.
I don't know if this is a related question, but could you refresh us on your investment thesis behind the position in Japanese treasuries?
So I didn't actually hear that. Sorry?
Could you refresh us on the investment thesis behind the position in Japanese treasuries? I don't know, that's the same question.
Yeah. In fact, I'll draw everyone to it, but about 3 weeks ago, I did a whole a Friday roundup on the yen. So maybe some of the people reading the Multi-Asset Investor had missed that. So I'll reprint that next Wednesday, because it's a bank holiday.
All right. The next question, which I think I like this one, isn't gold performance or the breakout down to Chinese buying, whether central bank or retail? China doesn't care about historical correlations with US-centric financial metrics, e.g. the 10-year yield or the dollar.
So the 10-year yield and the real yield, we touched on this earlier, is one of the theories. Another theory is that I think my preferred theory is, partly it's China, buying loads of gold, emerging markets buying loads of gold, central banks buying loads of gold, because they don't trust the US treasuries because of confiscation, and the money system is supposed to be free and fair, and it's not anymore. So there's that, definitely a factor. And that certainly you can pretty much measure the fact that that's offset the selling by Western investors in the ETFs. So you got that. But I think there's something else. And the other thing, it's just the broad, it ties in with the broad commodity rally, what we're seeing in copper and that sort of thing. And the idea that gold goes up is an inflation expectation indicator, which is something that's not being confirmed by the bond market. And I think this is the conundrum. It's one of the biggest questions in finance, is this whole idea of what inflation is going to be in the next 5-10 years. Is it going to be absolutely normal, which is what the bond market is telling you, or is it going to be much higher, which is what the gold market is telling you? And that will be resolved sooner or later. But I think that's the driver. And also the Chinese general public, as you say, are very bullish, and they're buying gold. There was a story about how they gobbled up some equity ETF in an afternoon and caused some premium, but actually that was more of a fat figure than it was a proper trend. But I think there's genuine demand around the world for gold. And of course, the Chinese citizens haven't got many choices. It's not like us, when they can, Bitcoin's sort of semi-banned here, but we can buy quite a lot of things here, whereas a Chinese citizen really has a much smaller choice of potential investments. So gold is very much high on the agenda.
What's your view on crude oil for the next few months?
Well, it's been soft. Indicators have been rising, and as I say, one of the fears is maybe it's telling you the economy globally is going to be a little, maybe the US and emerging markets, it's going to be a little bit softer. So maybe that's what it's telling us. But I'm a bull. I'm an oil bull. I just when everyone was telling you a few years ago that we'd never go back above 100 million barrels a day, I was adamant we would, and we have. So that journey continues. There's no supply squeeze at the moment, but long term we're gonna use more and more. And regardless of the energy transition, some people would even argue that you need it to enable the energy transition. So it's a secular trend. But it's also true to say that if you looked at oil compared to other commodities, particularly gold, it is looking like it's got quite a lot of value in it right now. I just don't think that if we had another event like the credit crisis, we'd see $37 oil at all. I really don't think there's much downside from here. It might get 70 for a short while, but I just don't see very low numbers from here. And let's not forget, the US strategic reserve has been emptied pretty much, or well on the way. And so there's a natural buyer that's got to come back one day.
All right, moving to the US, what's your view on the CRE loans situation in the US? I keep reading further expected bank failures amongst regional banks, etc.
So they're predicting all these regional bank failures after they started failing. And these would have been more useful warnings back then, wouldn't they? Then maybe I wouldn't have sold Marks and Spencer's. But I don't think we can expect a real estate boom anytime soon. We had a very, very long one going up into 2007. And it's remarkable that actually walls were given so quickly in 2009, and it just went on back on the escalator, and up it goes all over again. US house prices nearly twice what they were pre-08. It was quite extraordinary, and true here as well. Surely this highly interest rate sensitive area of the market is going to take quite a long time to sort itself out. I have been looking at Derwent London as my favorite potential property play over here in the UK. And there's a couple of others that I'm quite interested in. And there's a sort of slow burn value story. I mean, I was kicking myself for not getting involved in the German retail residential housing stocks, Vonovia and so on, about a year ago, because they were just so cheap. And they've done extremely well. But I do think that it's property is going to be fine at some point. And there are some stocks that look pretty interesting. But I just don't see a driver for it at the moment. But I would say, fine, I'm working from home. I mean, my local train station car park is filling up again, to the extent that it's bursting at the seams. So we had a new car park extension during lockdown. It was a bit of a comedy. So then lockdown came along in 2020, and the only thing you could use it for was go-kart track, because it was massive and flat and all that, and no cars in it. But now this extended car park post lockdown and all the rest of it is pretty much full on Tuesday, Wednesday, Thursdays. So that's an indication that working from home is thinning. Maybe not in the civil service, but in the private sector.
Right. What's your view on a US recession in 2024? Do you have a view on reducing risk before the US election, be in September or October?
It's very unlikely, isn't it? The deficit is going to keep the recession at bay for some time. I have heard that one of the risks that's probably not being priced in correctly is the refinancing by credit markets that could come next year. But we're not getting any market evidence of anything like that. So I mean, let's not forget in 2008, all those ABS indices were blowing up 18 months before the event. And there's just sort of no worry, nothing to see here, doesn't matter. But of course, it did matter a great deal. But we're not seeing anything like that right now. There's everything seems to be working, even though we kind of know the stories that are scary and all the rest of it. There's a huge amount of refinancing done during the pandemic that really has covered over a lot of cracks for a while. And so it's not. I don't think it's not really until we see some strains in the bond markets that we should be too concerned about recession. And we all knew one was coming in 2022, inverted yield curve and everything else, but none of it's played out.
All right, so two questions in a sort of similar area. With gold and silver, would you consider adding some direct exposure, i.e., in addition to the existing exposure to the GDX and the whiskey portfolio, and then asking, silver and gold, how do they compare? Which one would you choose?
Well, I would use both of them on a risk-adjusted basis because gold's lower risk and has lower volatility. Silver's nearly as volatile as Bitcoin, and gold miners are the same volatility as Bitcoin. I mean, that's it. So how much risk do you want to take? Or you could answer it another way. You could say put 5% in gold, or to put 1.5% into gold miners. Again, same risk. So gold or silver. I mean, silver's obviously got more upside if this rally continues, but it's got more downside if it doesn't. Hence the importance of talking about position size and this sort of thing. I mean, the whiskey portfolio is unashamedly bullish in alternative assets, and I think that is something I'm very happy to do. We basically what I've tried to do is sort of blend some ETFs in interesting areas like an investment theme or an emerging market or something, with some precious metals, which our weighting in precious metals in the past has been virtually zero. Pre-2018, there was a patch where we really didn't own very much at all. And then there's also a bunch of stocks, a bunch of liquid, cheap stocks. And the back of my mind, it's always the most important decision really is your split between those things. And right now, I'm very bullish precious metals, Bitcoin, that sort of thing. So it's about nearly a third of the portfolio, 30% of the portfolio is in those areas. So that's pretty high. Would I take it higher than that? No, not really. I mean, I'd like it to be higher than that because they double. So we end up with a huge amount of gold, Bitcoin, and all the rest of it because they've done so well. But I'm not going to allocate more than that. It's the job of the asset to make you the money to take the allocation into that sort of territory. But then at that point you're selling. But I see no reason to sell precious metals at this time. And basically what we're seeing is every time the dollar is softening, all of these areas just do very well. And in 2022, when the dollar was rallying, all of these things were under more pressure. So I think that's another really important point is how the dollar's acting, which is on the soft side, as it was between 2001 and 2008, which caused just a very buoyant time for equities.
Right. Finally, it was actually a question for me. I don't know if it's that topical, but it's a gold producer in West Africa. What's your view on Hummingbird Resources? And I would just say a sort of general answer on it. It's a company that, if you don't know anything about it, is for some reason, anytime they produce even sort of a sneeze of bad news, the shares go down 30 to 50%. And anytime they come up with good news, the market ignores it, which means they go from 10p to 5p, and now they're back at 10p. So it's one of those things that
the sentiment towards the company, maybe for legacy issues as well, the management communication has been negative. And it is interesting that you can almost buy it after bad news and know that it will bounce back because the market punishes it so heavily, which I suppose you get with a lot of small caps anyway, even now, even though things turn a little bit better. So I think it's an interesting stock just to see. It's a bit like a drug company. You have AstraZeneca has one failure and the shares are down 10%, but the drug would only have been 1% of the portfolio. So Hummingbird is in that sort of area. So it's an interesting one. I think it's buying on dips, and I think they will get there because obviously with gold where it is, even Coco the Clown can get a gold producing company away, and you can get the funding as well. So I'm an optimist in that company, even though it's been a horrible ride today.
Absolutely. Should we just touch on the British election, just for fun?
Yeah, that is good fun. It was a very opportunistic calling of the election time, just the day, I think the day after the lower the inflation being at 2.3%. I think that's basically, it is quite an achievement going from 11% to 2.3% in 18 months or whatever it's been. And I think that it is probably a sweet spot for the governments. It's the only thing they can hang their hat on now after 14 years. And it is a win, and it does rather kill what Keir Starmer was going to say, that we're in a cost of living crisis and prices are high and working families are struggling and all that sort of stuff. So I think the opportunity is there, and if Rishi Sunak has a chance, this is the timing is perfect. It's a shame that the Bank of England haven't already started reducing interest rates. But as my view is that they don't want the government to be re-elected. I think it's quite understandable. They should have lowered rates last month.
Yeah, that does make a lot of sense. And if you think about it, they got a couple of people onto the plane to Rwanda, and they've got the inflation down. And you just sort of sense that there's been a bit of and that sort of very warm speech he gave a few days ago about the blood scandal at the NHS, and you sort of feel all these things happen in a sort of short window, and that's dressing the whole thing up for an election, and they've been sort of putting some feelers out. I think it's going to be much closer than the polls suggest. I'll be gobsmacked if he wins, but we have to genuinely worry about a Labour government, because better the devil you know that's what his campaign's going to be, and it's true.
Yeah, but I'd probably stick my neck out and say that 20% is probably almost like neck and neck, or not neck and neck, but like a small conservative loss, let's say. It would have had to be 25% and more to know that Labour would win and have a 50-100% seat majority. So I think there is that issue, and then also a general election, more conservative voters would step up to the plate, especially trying with the school fee, with the VAT on school fees, etc., etc. So I think it would be probably a narrow win for Labour, but the Conservatives may still have a chance. I think, especially if the inflation goes down a bit more, or if mortgage rates go down as well in next month, which is unlikely, but that's possible. But you can't say that the last 14 years have been a resounding success. It would be ironic that the Conservatives would be kicked out for really delivering 14 years of Labour and Lib Dem policies.
And what about the man who used to, the chap who used to, or is the editor of the Fleet Street Letter? See, I think that I was the editor of the Fleet Street Letter for 6 years, and handed on that responsibility to the Nigel Farage. And Nigel Farage obviously has a key role in this election, because I suspect that about 3 days before the election, he'll say, "Please vote Tory," to all the confused people out there. And most of them will. What do you think about that? The wild card?
The wild card, from what I've heard, the wild card is that even though in theory reform is a big threat to the Conservative Party, largely because it's actually has conservative policies in its manifesto, the issue is that most of the reform potential reform voters don't actually vote. They just say they're going to vote, and that's the end of that. So apparently, it's 1 in 25 of the people who are sort of doorstepped about their intentions don't actually. The reform people just rather, you know, they're just armchair voters rather than actual polling booth voters. So that's the info I've had from a hopefully reliable source. So or you can almost forget about that. Apparently, also boundary changes are actually in favour of the Conservatives in Scotland as well. So that will also help. So it could be rather, as you say, it could be rather closer. And I think the 20% is not, you know, the polls, you know, that's not enough for Labour. So that means they're probably they're ahead by 5%, or, you know, is that kind of thing. So the sort of the polling hatred that you have, the protest vote through polling, the polls is not very reliable at all.
Yeah, well, it's going to be interesting because the energy stocks today, anything to do with the grid or utilities or what have you, are just being slammed in the market. And so, you know, these guys really are serious about going back in time. I've always said there's no point in nationalizing a company, because if you can regulate it and tax it, you don't need to own it.
Yes, but they don't know that. So that, you know, that's the problem. I think that you know, the Labour just doesn't, you know, the cliche is that you know, socialism is, you know, you run out of spending other people's money. We don't have any money for Labour to spend. So that's the problem. That's why we're taxed up to the eyeballs. I don't think they can tax us anymore. We've been absolutely crucified in the last few years. Obviously, the pandemic splurge, etc. So I don't see how they can actually do. You know, if they do come in, what else? They couldn't give us more red tape. They couldn't give us more bureaucracy, and I it's almost impossible for them to tax us anymore. Plus, you know, rich people just leave.
Yeah.
The system we have is that, you know, as soon as you make more than 200 or 300 grand, you can just leave the country. So all the rich people leave, and it's just on the middle classes and working people to pay the bills. And obviously, it's normally middle class people to pay the bills. So that's the problem. So yeah, I'm not saying it's the last person to turn the lights out, but I think that people will be more pragmatic. Hopefully, it's a 92 rather than a 97. I think, and
I think that's a very good point. But the final question for you, Zak, if there's a spare seat, if Labour get in and there's a spare seat, will you take it and go to Rwanda?
Well, only in the winter. You know, from November to March, it's a bit, you know.
That's exactly what I'm going to do. I'm going to live in Rwanda in the winter.
There is nothing better than Great Britain, in the summer. So I wouldn't do that. But I'm sure a lot of people want me to go to Rwanda. But at the moment, you know, it's very good.
So, ladies and gentlemen, thank you very much for listening. As always, fire in at charlie.morris@bytetree.com, and you know, I'll answer questions for the delayed issue next week due to the bank holiday. Thank you, Zak.